Hello, and welcome to another episode of IJS Speaks. This is Katie Mark, your neighborhood financial economist. And I know it's been a while since I last spoke about my trading. I talked about it towards the end of December, beginning of January. The markets were kind of thin and there wasn't a whole lot of volume being traded because of the holiday season. And then at the beginning of the year, you also had investors that were putting off taking profits on positions towards the end of last year, selling into the beginning of the year because of tax implications. Okay, so a couple weeks in, we're towards the end of January, we had a couple full 5-day trading weeks, and in the last couple days in particular, there has just been a lot of volatility in the market. And then there's also been a lot of talk about short sellers and Robinhood traders and options traders and everything and everyone. In an attempt to explain what's been happening with a select few stocks trading in the US, and apparently now the narrative is spreading to some stocks trading out of Europe. I'm not necessarily here to talk about short selling and short sellers, but I will say though that in a open market environment, you do need both long positions and short positions. And to say that there's a need for regulators to step in, as they usually do when there's some kind of market dislocation, to instinctively force regulation onto the market is the wrong approach. At the end of the day, financial markets are fairly free and they are fairly or reasonably accessible. Information is reasonably available. And it is up to investors to do due diligence and understand exactly what it is that they're buying and selling. And also to understand the risks that they're taking by buying and selling whatever it is that they're buying and selling. So, long story short, if anyone out there, institutional or retail, got caught up and had to realize losses in a short squeeze, the one thing they probably won't do going forward is to be overexposed to a short squeeze. So I think the markets are overall better for the experience. Market participants are overall better for the experience of losses that were unforeseen, because then they get a reminder that just because something is improbable does not mean it's impossible. And this is what market does. You enter financial markets to take risk and have opportunity for capturing reward, and sometimes risk bites you in the ass. So that's my 2 cents. In my experience trading, I've realized losses. Most times it was my fault. Sometimes it wasn't, but most times it was. And the only thing I could do is just reflect back on the situation leading up to it, reflect back on my decision making through it, and pick the things that worked, do more of those, isolate the things that didn't, and do less of those. So, long story short, it's a learning experience. We all get to understand a new angle or a facet of financial markets. And now going forward, we can all talk about the time when we saw the short squeeze in GameStop or the short squeeze in AMC. So, but long story short, Financial markets have been dislocated for a long time. This is just a new facet of dislocation, but this too shall pass. Okay, so on that note, let's jump into the dashboard. So on the dashboard, for those of you who are familiar, I'm looking at the US dollar index, US 10-year Treasury note, gold, S&P 500, and crude oil futures. Now, what I'm seeing as of, what's today? January 29th at 12:57 p.m. Eastern Standard Time. The dashboard is overall flashing risk off. Let me explain. With the dollar, so the dollar and the 10-year are my two liquid or liquidity driven assets. So they are a proxy for safety and or risk aversion in financial markets. So my interpretation is whenever I see the dollar and the 10-year trending higher, investors are typically demanding liquidity and safety. So liquidity in the dollar, safety and liquidity in the 10-year treasury. Simultaneously, if I see riskier assets or inflation sensitive assets like gold, stocks, and crude depreciating, like I see now, typically means investors are selling their riskier assets and seeking out quality and liquidity. So you're buying safety, you're selling risk. That's a risk off day. That's what the dashboard is telling me. It's signaling to me right now. I want to talk about the S&P 500 in particular, and then I may touch on the other ones. So I've been long stocks, and I typically hold a net long position in equities. Because, of course, with the whole upward bias over time and me being as young as I am, or I guess as old as I am now, I feel like I have time on my side to a certain extent when it comes to investing in equities. So I tend to have a net long position. And with the level of accommodation in monetary policy specifically, and more fiscal policy accommodation being added to the mix, the expectation and in most cases the realization was risk assets going higher because of the threat of inflation. Well, and also with the monetary policy, the liquidity being provided by the central banks, and blah blah blah, putting money into the financial markets as demand for risk assets, because you have liquidity and safety being added to the market. Investors tend to not want to flock towards liquidity and safety. They shy away from it and they go after risk. Well, so in the portfolio, I had my long positions in equities, and then I would trade around them. I would trade commodities. I would look at oil, for instance, and I would look at how it's playing around with gold, and I would try to make some inferences into some of the commodities, namely corn and wheat. And for the most part, it's been, trading's been successful, it's been profitable. But what I have noticed at certain points when the S&P 500 will pull back, I would add, for instance, like a derivative position, like a call option or something, maybe vertical spread. To get some added long exposure in the S&P, because again, of that bias that I have with expecting the S&P to move higher. And the past few times I've taken this position, I ended up having to close out the trade at a loss. And it just occurred to me today that the overall market, well, using the S&P as a proxy, that stocks seem to be losing momentum. So it just seems that the S&P is having a hard time making a new high, and instead it seems to be moving closer and closer to making either retesting old lows or making a new low if we do see maybe one or two more significant down days. And that to me is a bit worrying. And today, again, after closing out yet another derivative position, going long on stocks at a loss, and looking at some of the macro fundamentals as well. Now, I typically try to shy away from macro fundamentals when trading, and more so depend on it for investing. But in this case, the macro fundamentals and the financial markets, after a period of dislocation, seem to be relocating towards each other. So let's take COVID, for instance. Every month or so, there's a discovery or an announcement of a new variant from some part of the world. And then shortly thereafter, there's an announcement that it's been confirmed in the United States. There have been many delays. There have been many operational shortfalls in the production and distribution of the vaccines. And even administering the vaccinations, there have been issues because there is a disconnect between the federal level and the state level in terms of organizing and allocating resources. I don't want to outright call it a cluster, but we're getting pretty close to a cluster. In the meantime, equities have just been pushing higher. And a lot of the pundits have basically been saying the stock market is forward-looking. It's looking through the short-term pain that we can expect around COVID and looking through to, a better economic outcome. Well, as of the past couple weeks, it seems like the stock market is losing its enthusiasm around a better economic outcome being around the corner. What I have done personally in response to this, I have reduced my equity exposure. So I looked at the overall exposure, the amount of stocks that I had in my portfolio, and I started paring back my exposure. Across the board, my equities were up because, again, you buy them and hold them and they just go up in value. That's what they've been doing past several years. So started reducing exposure, locking in profits, not a problem. I had to realize some losses on some of my derivatives, Again, not a problem. You win some, you lose some. But the goal in my mind was to raise cash and reduce exposure to the equities, or at least to the equities market. It just seems that risk assets are losing a little bit of momentum from here. My expectation, some kind of a consolidation. Buyers and sellers try to figure out should the price go higher or lower. From what the price has been doing, it seems like whenever buyers and sellers come to these consolidation points, the sellers take over, push the price lower. So that's my expectation. That's why I decided to pair my exposure. At the same time, on the derivative side, I had a vertical, a call vertical on the 10-year treasury. So bought a call, sold a call above it. From where I entered the trade, the position was down. So for those of you who understand, or those of you who trade options and understand verticals, you buy one at whatever price and you sell one above it. So you capture the difference, the spread in between. But you're basically putting a cap on your upside with the one that you sell. Well, the position is down from where I initially opened the trade. The call option that I sold was almost at its maximum gain, so I liquidated it. And since the S&P started, and this was a little bit before we saw that big push lower, so I want to say around the London close, so around 11:30. Ever since S&P's been pushing lower, and the call option, the call option that I have on the 10-year has actually been regaining its some of the value it's lost over the past week. Meanwhile, I haven't locked in the I guess the profit on the one that was sold. Now I'm also looking at, well, not looking at, in the portfolio, I've got futures contracts on the Australian dollar versus the US dollar, the British pound versus the US dollar, and the euro versus the US dollar. And that's also been the avenue through which I have been trading the movement in the US dollar with those currency futures. There was a while, because if you remember, at the end of December, coming into January, there was this narrative that the dollar was just going to go short. That, there's supposed to be this, this rebound internationally, and U.S. investors are supposed to sell their dollars, buy foreign currencies to make investments in foreign countries. That narrative, which again also went along with the assumption that better economic times were around the corner, also seems to be fading. So I've been looking at the dollar, and I had these long positions in these currency futures in anticipation of the dollar falling and those positions appreciating. Well, I've had a couple weeks of just choppy trading, but just net drifting a little bit higher on the dollar, which has been pushing down the value of my positions. Long story short, earlier this week, I ended up hedging the positions. So I've got my front month, which I am long on those currency futures, and my back month, which I'm short, which is basically the long dollar play. And interestingly enough, the British pound has held up really well. So the short dollar, long pound position, I was actually able to close out profitably. and keep the long dollar short pound position in anticipation of the dollar moving higher in the coming trading sessions. The euro and the Aussie futures, though, they're still hedged because I guess the timing or just market pricing or whatever was off. So they're neither leg is positive. One is more so than the other, but neither one is But looking at how the dollar moves, and especially in tandem with the 10-year Treasury, if I can see appreciation, or if I do see appreciation in the 10-year Treasury, and the correlations between the dollar and the 10-year Treasury remain strong and strongly positive, then I can feel confident going into next week's trading sessions that on the currency futures, the ones that are long dollar, short foreign currency, on those legs, I may be able to double down on those positions because it seems like the dollar bounces around in tight trading ranges. So the idea is for my currency futures positions that are hedged, whichever leg is appreciating in the short term, I double the position. It peaks, it turns around, I close the extra position and reopen the hedge. If it turns around, I double up on the opposite trade and just basically trade a range, which the dollar seems to have been doing for the past couple weeks, pushing into a month. Well, maybe 2 or 3 weeks now. So if that range continues, then the idea is just to bounce back and forth between a long position and a short position, adding and taking away exposure on the long and short side, depending on which direction the currency is moving. But maintaining some level of a hedged base, simply because I'm not very clear on where the dollar is going in the medium term. But I mean, if I were to base a trade around a macro fundamental narrative, I would say that in the short term, the dollar goes long as the markets enter into a risk-off period. But as that sentiment reverses, so should the trade. When it's going to do that, no idea. But that's where the technical analysis comes in. I personally like to use regression curves. I'm a fan of statistics. I think it's very representative of the real world. And regressions are a way of capturing, or the regressions, standard deviations are a way of standardizing the statistical price ranges that the positions cover. And I like to use my regression curves as support and resistance. And right now, the dollar index is breaking through its regression curves. So it's going from a point of using its regression curve as resistance to, depending on where these candles start closing, using its regression curve as support. So that's the technical confirmation that I'm looking for to really step on the gas when it comes to the long dollar trade. Meanwhile, crude oil looks like it's doing the opposite. It's losing momentum. Its trend is already negative. And it's also using it's breaking down through its regression curves. So it's going from possibly using its regression curve as support to now maybe using it as resistance. Then we've got 10-year Treasury. 10-year Treasury, the momentum is definitely short on the 10-year Treasury. The trend is short, but the momentum is turning around. The price is also breaking through its regression curves. So I'm looking for a transition from using the regression curves as resistance to now using them as support. And again, in tandem with the dollar moving higher. But the dollar, the momentum on the dollar, well, the momentum on the dollar it's negative, but the trend on the dollar is positive. So longer term trend signals are pointing higher versus shorter term momentum trends, which are pointing lower on the dollar. And then we get to gold. Oh, gold. So I've been looking at gold, and I've been looking at gold for about a month now. And I pulled up a 1 year 1 day chart, and I highlighted a bull flag pattern. And ever since, I've been looking for a breakout of that bull flag pattern on gold. I've had two chances or two opportunities that I thought were breakouts, traded them both, timed it perfectly, whether by accident or not, timed it perfectly, and was able to take profits both times before gold turned around. Today being one of those days. So the first time I was looking at some 180 calls. This time I was looking at 175 calls. Again, I was able to take profits on that, but gold does seem to be moving in tandem with other risk assets. So, for instance, its trend is turning positive. So it's going from so it went from a falling trend to sideways trend, and now it's turning positive. Its momentum is positive, but it's reversing. And I have a strong suspicion that by the end of trading day today, when these indicators update, that we're gonna see an overall change in direction of the momentum measure on gold for the day. But got out of the position. Overall, my expectation is for gold to go higher. But looking at longer term charts, the price $17.76 on an ounce of gold. It's looking like a long-term support resistance level. If I get much more breakdown of the price, then I could take that as confirmation of a short toward that long-term support resistance level. But I also have not gotten confirmation on a short, because both of my gold trades have been long trades and they have been profitable trades. It's just that the price spikes up, brief consolidation, and then retraces lower. So it's effectively been a trader's market in gold. But overall, when stocks start moving higher, when investor sentiment changes again, we will see equity prices move higher, as well as other risk assets, including inflation-sensitive ones like gold. And then again, especially if, the Biden administration can get even a fraction of the fiscal policy plans that they have implemented, then we can definitely see a continued increase, or at least a reversion back to a trend higher for risk assets like gold, stocks, of course, and commodities, soft commodities, energy commodities, and agricultural as well. But as it currently stands, the momentum on the S&P 500 is negative and falling, and the trend on the S&P 500 is negative and falling. So, with that being said, looking at the indicators that I'm looking at, and also taking into consideration the macro fundamental narrative around COVID and the struggles that most developed and developing economies are having with the vaccination rollout, I do think that equity markets got a little bit ahead of the real narrative, and maybe, just maybe, we're looking at some kind of a repricing. Another thing I do want to mention about the equity market, though, the price action in recent days, especially around the short squeeze that was being experienced in U.S. equities, the price action eerily reminds me of what we saw in 2008, the summer of 2008, with crude oil and other commodity prices. Granted, those markets were a lot smaller, and it didn't take much to get the outsized price movements. A lot smaller, a lot less liquid. But the price action, it really does seem like something in its death throes. Now, I do understand that the Federal Reserve is standing ready, and unlike 2008, would more than likely react much quicker to a sharp market sell-off. 2008 took them months. 2020 took them weeks. So, if there were to be some kind of a sell-off, 15, 20, 25% on the S&P, the Federal Reserve will no doubt step in, backstop markets, and reassure market participants that they will be there to make sure that liquidity and stability remain tenets of U.S. financial markets. So again, I decided to raise a little bit of cash simply because if an opportunity arises, I want to be able to buy the stocks that I am holding in my portfolio at a discount, so that I can reduce I can lower my break even and not even dollar cost average, just trying to time it, but reduce my break even basically. I could be wrong. This could just be a breather before the market continues higher, and if it does, I still participate because I didn't liquidate my entire stock portfolio. The downside is I get to buy back some shares that I sold at a slightly higher price. But as is the risk of trading financial markets. Okay, so let's see what else we've got going here. Crude oil, dollar. Okay, so that covers the dashboard. And talked about commodities. Depending on how confidently the dollar trends higher, I will consider looking at short commodity positions. So for instance, if I see gold pushing lower, as well as crude oil pushing lower, I will start looking at soft commodities like corn, like wheat, maybe soybeans. And I will start considering taking a short position in those commodities. On a short term, of course. So nothing out past more than about 2 weeks, maybe. No, it's futures. So nothing past maybe a month or so. Unless, I have to buy the outright futures, which may have an expiration date out 4 weeks, 5 weeks, 6 weeks, 2 months. But if it's just a pure derivatives position or it's just an options on a futures contract, I'll probably only play that about 2 weeks out at a time. Just to make sure that if there is a sudden change in market sentiment, I would be able to pivot the portfolio. And also with the derivative contracts, you don't necessarily get to capture your maximum profitability until at or close to expiration, because there's that time value factor into the price of the options. So the shorter the time to maturity, the more of that time value erodes away quicker, and the more of the full profitability you get to capture, or maximum profitability you get to capture, as you hold on to an in the money position. For instance, I had a vertical call spread on corn, which had like 21 days on it, which the thing was in the money within I think 2 days. And well in the money. And it was a vertical, so there was a cap to, the maximum amount of gain. So long story short, I sold the vertical today. It was profitable, but it could have been more profitable. But sold the vertical today. And personally feel like I left some money on the table. But if it was shorter dated to maturity, more of that profitability would have been captured by the time I got around to selling. So that's my takeaway from that. Sometimes I do need to go further out with my options positions. Other times it's best not to. And then, of course, the use of technicals. I do most of my research, most of my analysis is done using technical analysis techniques. I've recently even started working with some clients in educating themselves about educating themselves about investing using fundamental principles. And I mean, I can honestly say if your time frame is as short as mine is, you really don't need to do, or I don't see the need to go too deep into a fundamental analysis past a general narrative outlining whatever market it is that you're trading. Simply because market prices on the short term can be so dislocated from fundamentals that you could just end up spinning your wheels, or worse, getting caught in a paralysis of analysis. So, now for the investors out there, long-term investors, buy and hold people, your fundamental analysis is of the utmost importance, and understandably, because you need to be confident that you buy something and you hold it, that it's going to maintain its value at minimum, or at best appreciate and or pay you some kind of a dividend income. But trading for short-term or medium-term price movements, not necessarily a concern of mine what the balance sheets are or what the cash flow statements look like, unless it's right around some kind of unless I'm owning something right around a data release, and then it's relevant stuff like that. I try to stay away from, but yes, the importance of technical analysis. When in doubt, when you're unfamiliar, you can always gain insight from looking at what the price has been doing, simply because every market participant that has affected the price has done some form of analysis, and you aggregate all those analyses together and you get their decision making that has set the price at what it currently is. So based on all the information, or most of the information available to the market has set a price. The price may not be the right price at the time, but it is still the price at the time. So, and that's honestly why I don't necessarily think regulators should be too quick to regulate market mechanisms. You know what? I'll rephrase that. I don't think regulators should be too quick to regulate market participants, but they can regulate market mechanisms. Because there are some mechanisms that allow for situations to become exacerbated. Those mechanisms can be regulated. But as far as restricting investors' access to products, I don't necessarily think that's the best way to go. Because if someone wants to buy something, someone wants to invest in something, they're going to find a way to do it. Even if they have to, use someone else's address in another country to open a brokerage account in another jurisdiction, they're going to do it. So, but that's a philosophical debate for another time. On that note, if you have any questions, comments, or concerns, you can reach out to me at contact@runthenumbers.biz. That's contact@runthenumbers.biz. And it's been good talking to you. I haven't had a second to really get on the mic and talk about my trading in a couple weeks. Been a little bit busy rolling out a new service offering for the consulting side. So that's been time consuming, but I have still been making time to trade and to keep track of my charts. So, and honestly, that's my me time. That's the time when I get to sit down and just shut the world out and focus on the things that that concern me and hold my attention. So, but on that note, this is KD Mark, your neighborhood financial economist, signing out. Remember, when in doubt, take profits. I missed 2 opportunities this week alone in taking profits on a call option on the S&P. But hey, I thought the market was going to keep pushing higher, and the momentum, the buyers basically were not able to step back in and to outbid the sellers. So seems like the sellers get to set the tone in this market. I don't like the look of it from where I'm sitting, so I reduced my equity exposure. Hopefully we get a sale pretty soon. I can buy some more and get back to making money. Okay, so on that note, like for real this time, this is KD Mark, your neighborhood financial economist, signing out. Remember, when in doubt, take profits.